All right, Stewart, the floor is yours.
All right, thanks. Let me go ahead and share. And then let me open up the chat windows in case anyone has any questions. Okay. Okay, so this actually is a kind of abbreviated version of two of my presentations. So we'll first cover the financial planning best known methods as at Intel, we call them BKMs. They're also kind of known as best practices. This is, you can email me here, homefreephoenix@gmail.com. If you want to copy the presentation or if you have any questions. But let's get right into it. Okay, so quick disclaimer. So all investing involves risk, right? Regardless of what I say or what someone says on TV, et cetera. And past performance really has no, is not used. You can't really predict the future with it. And then all the opinions that you'll see here are just my opinions, right? So everyone's situation is different. So you should really consult the appropriate, your appropriate experts for any financial planning advice. So feel free to ask any questions, or if you want to type them in the chat. We should have enough time to, hit them as we go. So quick agenda. I'll cover my background, and then I'll go into kind of my first presentation, which is how do I achieve financial freedom? I'll cover the 3 financial basics. I'll cover the net worth life cycle. And then I'll go over the BKMs or best known methods by phase. And actually I'll skip the last 2 phases, which is like the pre-retirement and the retirement phase, so that we can hit what retirement savings accounts should I use. So here I'll cover kind of quickly the different savings accounts, and then kind of show those. We probably won't have time to go over the tax implications on those or some of the tax strategies, but all the material will be there. So if you want to get a copy of that, just go ahead and email me. Okay. So real quick, again, background. I have a BS in material science and engineering from Cornell, MBA from MIT, focusing mostly in manufacturing and operations, and then also an MS in material science and engineering. So you might be wondering, hey, this guy doesn't have any degrees in finance. He's not a CPA. Why am I listening to him, right? And the reason is that through my career at Intel and through life, we've made a lot of mistakes. We've bought individual stocks, we bought on margin, just tons of mistakes. And so really I put this presentation together to, kind of document moving forward what I would do in terms of my strategies for retirement. But then when doing that, I looked at, okay, what, things do people need to know, as well as, okay, if I were, just starting out again in my career, freshly hired, what would I do differently? How would I change things so that I don't make the same mistakes? As Caleb mentioned, so I retired at age 46 after 25 years at Intel. I have 2 kids, 13 and 11, or 12, sorry, 12 and 14, sorry, and an Intel spouse. So, things are really busy when you have 2 working parents and, 2 kids. And, we don't have any nannies or anything like that. All right, so let's move into the financial basics, right? So the first financial basic that I want to talk about is investment returns by asset class. If you look at the graph on the left, that's the US stock market, including some precious metals, the dollar, for the last 200 years. And then the one on the right is, just looking at basically the last 100 years. And you can see, different assets have sort of different expected returns, right? And in this case here, you see stocks kind of leading the way versus, bonds or precious metals like gold or even the dollar, right? The one on the right kind of breaks it out by small stocks and large stocks. And obviously there is variation if you look in the kind of a small time period, but over the long term, right, you kind of have these expected returns that you would see for these asset classes. So here I just want to kind of highlight, different assets have different expected returns. But by far, cash is always the lowest, right? And if you look here, cash is losing value over time versus some of these other things. So ideally, you want to have your cash or money in assets that are appreciating in value. And depending on your own risk tolerance and other things, what you choose will vary, right, based on a kind of personal decision. But you want those things to be in assets that will be gaining in value. All right. The next one is power of compounding interest, right? So in this example, you have John and Mary, and say they're they're both seniors that graduated from UCLA, and they got excellent jobs at Google, right? And here Mary, right, decides, hey, I'm going to start saving for retirement, and I'm going to save $250 a month for the first 10 years, right, of graduating. Meanwhile, her classmate John, right, he decides, you know what, I have, I've always wanted this brand new BMW, so I'm going to go ahead and lease a Beamer for the first, 3 years. It's only $250 a month for the lease. It's a steal, right? So he does that, and then he leases the car again after the lease term was up, does it for another 3 years, and then he does it again, right? So the first 10 years or so, he does not save any money for retirement. And then at age 30, he decides, you know what? I'm 30, I need to start thinking about retirement, right? Because, I'm not a spring chicken anymore. So he starts saving $250 a month, and he saves it for the next 30 years until age 60, right? And in this case, Mary stopped. She stopped at age 30 for whatever reason. But at age 60, right, Mary actually has more money than John does, right? And this example here assumes that everything is growing at 7% annually. So if you think about this example, right, Mary could actually start leasing a car at age 30, and she could lease that car for the next 30 years, right? Essentially, that's what she did. She didn't save any more, right? And she still has more money than John, all because John decided, hey, I'm not going to save for the first 10 years, okay? So the main message I want to get across here is start saving early, because it has huge ramifications. And the reason why Mary has more, right, is because of this, right, of what's going on here. So the rule of 72 answers the question of how many years does it take to double your money, right? So if you have something growing at, say, 10%, right, you would take 72 and divide it by 10, and you would get 7.2 years. So every 7 years, that money doubles in value. Okay, so if you look at this table here, we have some examples, right? You have 3% growth, 6% growth, and 12% growth, right? So if you start with 10,000 in year 0, and you don't add any more, okay, 10,000, at 3% growth, right? It takes 24 years for that 10,000 to double in value, and then another 24 years for that 20,000, I guess at this point, to double, right? But if you're at 6%, right, it's doubling every 12 years, right? And then in the example here with the 12% growth, right, it's doubling every 6 years. Now, I know you're thinking, okay, 10,000 and it doubles, right, say to 20,000. That's a nice bit of gain, right? And so you'll be very tempted to spend it. It might be a nice vacation, maybe it's a used car, right? So you're very tempted to kind of spend this money. And then even the 20,000 to 40,000, right? 20,000 is kind of a really nice used car. And then 40,000 to 80,000, right? 40,000 there, right? The brand new car, possibly. But really, these amounts that are doubling here is not a life-changing amount, right? It's a car, maybe less, some nice payments for down payment for a house, et cetera. But look at this last one here, right? Where you're going from 1.2 million to 2.5 million, right? Now that is a significant amount of money, right? That's doubling, but all in the same time frame, right? Of the 6 years. So the earlier you start, the greater number of doubles that you can have in your life. And the last double, by far is always the largest, right? And can be quite significant. So this is why in Mary's case, she had more money than John, right? Is that she started earlier and got more doubles in, even though she didn't contribute, for the, last 30, 40, whatever years. Whereas John started much later, he just wasn't able to get as many doubles in. Okay, so those are kind of the financial basics that I wanted to cover. Now here we'll move into the net worth life cycle. So this is, so once you start working in these companies, you'll start to find that, they love these life cycles, whether it's a product life cycle or software development life cycle or whatever. But so this is the net worth life cycle. So the first phase is what I call the debt elimination phase. So the focus here should be student loans and eliminating those. Phase 2 is what I call the accumulation phase. And here is probably the longest phase of your life and career, possibly. And here, what the focus should be is automated investing. Okay, you're going to be very busy in these phases, and the last thing you want to do is be thinking about what to invest in. The third phase is the pre-retirement phase, or what I call the asset allocation, right? So this is where you start getting close to retirement. And then the fourth phase is the retirement phase, or safe withdrawal. So how do you spend your nest egg? How do you spend this down so that you don't run out of money? And if you look at this graph here, you'll see, you have the green line, and then you kind of have this beige cone of uncertainty. So this is kind of the error bars around this line. And you can see, as you're accumulating your wealth, the error bars really are not that large. But when you start spending your money, the error bars grow drastically, right? You could have so much money, you just can't spend it down fast enough, or you run out of money before you die. And now that you have to go to and be a Walmart greeter, or maybe live with your parents. Live with your kids. So for today, though, we won't cover phase 3 and phase 4. We'll focus on 1 and 2, and then we'll jump into the investment stuff, or retirement accounts, actually. Any questions on this? Okay. So debt elimination. So you want to pay off your debts as fast as you can, right? So these are your school loans, credit cards, mortgage. Credit cards should be number one in the priority list. If you're carrying credit card debt, that is just really bad. And you should not carry any credit card debt. School loans would be the next one to eliminate. And then the mortgage. Now the mortgage, to me, the mortgage loan is perfectly acceptable, especially if the interest rate is low. So if people are able to get interest rates of, less than 3%, for me, that's plenty fine to carry for years and years. But some people like to, pay off the mortgage as fast as they can. It's not a bad thing. A lot of it is just personal preference and what you're more comfortable with. When you start working, you're obviously going to be getting hopefully a nice paycheck. And hopefully the companies offer a lot of benefits like 401ks, employee stock participation, where you get to buy stock at a discount. So for these, right, you want to automate your savings and invest the money. So the first one on the priority list, and these are kind of in a priority order that I would do, is you want to max out your 401k contributions. And then in this phase, you have kind of two choices. You have a pre-tax 401k and a Roth, which is after tax. Here, I would do the Roth 401k since you're just starting out and you're probably in a low tax bracket. So it's better to pay the taxes now instead of when you retire. And your minimum target should be what the company matches. A lot of companies match what you put in. So if you put in 5%, the company will give you 5% as well. So for example, Intel matches 5%. So that's your minimum, right? 5% should be your minimum just so you get the free money. But really, you should be trying to max that limit out. And that limit this year is $20,500. So say you have a starting salary of like $100,000, right? $20,500 of that will be going into your retirement accounts. The second one is I would max out any employee stock participation plans, right? So this typically, companies will allow you to put 10% of your paycheck towards buying stock at a discount. And then with that stock, you can either keep it or you can do what they call a quick sale. And so at the end of the 6-month period, you can set it up so that it automatically sells. Quick selling is good because you lock in, for the most part, any profits. Whereas if you don't sell it and you hold on to it, say for like a year and a half to get preferential tax treatment, it's possible that that stock price goes down and you actually lose money. So quick sale is one way to just kind of lock it in, ensure that for the most part, you'll get a profit. And it's also a good way to not accumulate so much company stock. That was one problem we had where, we had stock participation, we were getting RSUs or restricted stock units, both, my wife and I. So we were just getting tons and tons of Intel stock, right? And when you're about to retire and then like Intel stock takes a nosedive, you get really nervous that all your net worth is in, company stock. And, fortunately, Intel hasn't gone belly up, but there are lots of companies that, that has happened to. So you don't want to, have all your eggs in one basket. You want to, the next one is you want to max out a HSA. HSAs are health savings account. So when you start working, companies will usually offer a few different healthcare plans. One plan is called a high deductible, meaning, it's not, when you go to the doctor, you'll be paying, $100 to see the doctor. versus in the old days where you or your parents might pay $20, like a copay, regardless of how much it costs. You just pay a set price. With high deductible plans, you see the kind of the full price of the care. But with high deductible plans that have HSAs or health savings accounts, you're allowed to put money into an account that is basically yours, right? So if you move companies, that money stays with you. So if you're healthy and you never see the doctor, right, high deductible plans are a good thing. And with the HSA, that money is not taxed. You can invest that money and it grows tax-free. And then if you spend it on qualified medical expenses, it also doesn't get taxed. So ideally here, you would use the HSA as a retirement account. You would invest it. You don't spend it. You just let it grow for like 10, 20 years, right? Try to get as many doubles as you can. And then the other thing is save your receipts. So if you have like you broke your leg and you had to have surgery, you can save that receipt and reimburse yourself, 20 years into the future, right? Or down the road. So save your receipts and you can use the HSA as kind of a checking account. Next one are IRAs. IRAs are individual retirement accounts. These are accounts that are offered to anyone that has any earned income. So these are not offered by your company. They would be offered by different brokerage firms. Here you can put in $6,000 a year. Ideally, you would do a Roth IRA where you take the taxes out now and then you never have to pay tax again. The last one here is a after-tax 401k. So I'll cover this later. In this phase, most likely you won't have enough money to put into this, right? Because if you're maxing out your 401k contribution, which is $20,500, and say you're maxing out employee stock, say that's $10,000 a year. HSA is another, say $3,500. IRA is another $6,000, right? Those are all big chunks of change. The after-tax 401k contribution is around another $30K that you can sock away into retirement. So if you're still living on ramen noodles and really going cheap, you might have some extra money. But we'll cover that one later. So main point here is automate your savings and invest it. Try to start saving as early as possible. Okay, the other one is a lot of high-tech companies offer restricted stock units or RSUs. Basically, they give you stock about once a year, and basically for the stock, you kind of have to reverse it. You have to think about it differently, right? So you kind of have to ask yourself, would I buy my company stock with a cash bonus, right? So say you get $5,000 in stock. Think about it as cash, right? Would I buy more, Google with my $5,000, right? If you're already getting, and you're participating in the employee stock plan, maybe you don't want to buy more, Google stock with your cash, right? So if the answer is no, I would not buy, my company stock, then you should sell those RSUs right away. And the reason is when those RSUs vest and the company gives it to you, they already tax you and they already take out all the taxes. So the day that you get it, it's essentially like cash, right? So if you just want the cash, then you should sell your RSUs right away. And the idea of selling it right away is that you want to minimize the price change from when it vested to when you sell it, so that there's really no tax implications. And then the other reason to sell it is that you want to diversify. Employees have way too many eggs in their company. And by doing this strategy, it'll help prevent you from having so much company stock, 10, 20 years down the road. When, you make a lot more money, maybe you're married, maybe, now you're in these like really high tax brackets, and now you're trying to sell company stock that has appreciated in value so much, and then it just moves you into very high tax brackets. Okay, second other item here: don't overspend. So big homes, fancy cars, jewelry. Just try to control your spending. It's hard because buying things is kind of fun, but eventually you'll get to a period where like you just have too much crap, and then you need a bigger house to hold all that crap, and then you got to take care of that crap, and then it's just a burden. So try not to overspend. Continue exercising. So this one here really isn't a problem, I think, for this age group and in this phase. I mean, but definitely exercise. This link is Exos at Home. Exos is a company that basically trains professional athletes. A lot of the NFL prospective athletes go and train with them before the season. But this company also has, other trainers that they actually run all of the Intel fitness facilities. And we take they offer classes there. And the classes are wonderful. They lead through a full body, workout, stretch, warm down. They have you working on exercises that, focus on your core, rotational stuff, everything. And, the benefit of this is that you don't have to think. And, in a short amount of time, you get, everything done. It's kind of the best bang for your time. Okay, so phase 2. Are actually any questions on phase 1, debt elimination? All right, let's move to phase 2. So phase 2 is what I call the accumulation phase. So in this phase, it's kind of you eliminated your debt, and you now have pretty good buying power, right? So and the accumulation here is accumulating net worth versus accumulating goods, right? So again, you don't want to overspend. Big homes, fancy cars, etc. All of these things are at this stage very easy for you to do, and you really don't need to think about it, right? It's like if you want to go buy a Tesla, right? You can probably easily go afford it in this stage. So try not to overspend. Again,
Stuart,
all your student loans and credit card debt.
Real quick, there's a question in the chat.
Yep. Would you put your money in a Roth instead of directly in S&P 500, for example? Yes, I would. So this one, for a Roth IRA, and I'll show it later, right? You can actually invest your money in the Roth IRA and then just buy an S&P 500 index, right? The Roth IRA isn't, it's just a type of account versus a type of an investment, if that makes sense. Like in your Roth IRA, you could buy individual company stocks if you want, or you can buy the index funds. So, but it's how it's taxed and how it's treated that makes it powerful. And so on the, after this slide, we'll go into that, and you'll see the power of the retirement accounts. All right, good question. All right, so student loans and credit card debt should be paid off. You should absolutely not have any credit card debt. Now note, I'm not saying don't use credit cards. I'm just saying don't carry the debt. So whenever you get the statement, you should pay off that balance in full, right? This will elevate your credit history. It'll allow you to get good loans, lower insurance rates, all these good things. So do not carry credit card debt month to month. Plus, they charge an outrageous amount of interest, right? So the same interest that was working in your favor for the rule of 72, right, works in reverse when it's when they're charging you interest and charging you extra money to pay off. So do not have any debts in this phase. Okay. Automate your investing with a simple 3-fund portfolio strategy. So this here is a link to the 3-fund portfolio strategy. Really, the 3-fund portfolio strategy is kind of the S&P 500 or total stock market index fund, a bond fund, and some international stock funds, right? So you want to make the decision-making and the investments as dumb as possible, right? You want to take advantage of the market growth, right, that we saw in the first financial basic, without having to think or pick, right? What are the high-flying stocks? You don't want to let your cash sit, right? So in this phase, you're probably well compensated, you have large paychecks, you're getting a lot of excess cash that's coming in that, right, that, maybe you can't even, send it towards the 401ks and all those other things, right? You have even more that is, going directly into your checking account, right? And a lot of people don't have a strategy, or they say, oh, I need to figure out what to invest in, right? I need to figure out what stocks to buy or what mutual funds to buy or this or that. And so, they basically say, oh, I'm gonna figure it out on the weekend, right? And in this phase, right, you might have kids, small kids, right? So the weekend comes and you take them to swimming lessons and soccer lessons, and there's a birthday party, and you basically never get to sitting down and figuring out what to invest in, right? And then you're like, oh, okay, next weekend I'm going to do it, right? I'm really going to have time to sit down. And then next weekend comes and goes and never happens, right? And then Intel people, especially, Intel gives sabbaticals, right? So every 4 years we get 4 weeks off, or every 7 years we get 8 weeks off. And so, a lot of people at Intel are like, oh, I'm going to wait till sabbatical to figure out what to invest in, right? What segments I want to get into, et cetera, right? That's 4 years, right? Possibly of wasted time. So you don't want to let your cash sitting, right? You want to remember the rule of 72. You also want to minimize your expense fees, right? So a lot of times, and this happened to us, we had bought individual stocks, you got busy, and all our investments are just not doing anything. So we're like, you know what? Let's have someone manage our money, right? I mean, at least this way, like, it'll be working for us versus not doing anything. So we, paid like a 1% expense fee for someone to manage our money, right? And they bought a bunch of index funds and did this and that. And we're looking at it, and it's like, they're actually not doing better than just an index fund, right? They're really not outperforming the market, and yet they're charging me 1%, right? And so you want to minimize these expense fees, right? Because it's really hard to beat just the market or the index, right? It's very difficult to do it. And most even actively managed funds do not beat it. So why pay fees for that, right? And so if you have an index fund that has like 0.05% expense fee versus, like, say, a mutual fund that has like 0.5% fee, there's just really no need to pay that additional amount for not beating an index fund. The other one is, don't be tempted to buy the hot stocks, right? Your friends might be saying, oh, I bought GameStop, or I did this, or I did that. No one, if you and your friends are talking about stocks, right? It's rare that you will come across a friend that says, oh, I bought this stock and it went bankrupt and I lost all my money, right? No one brags about losing money, right? But they'll brag about buying, oh, I bought Apple when it was $5 or this or that, right? Everyone likes to highlight how smart they were. right? But they're not going to tell you how dumb they were when they bought, this particular stock. And if you remember, you don't need to buy the hot stocks, right? Because one, it's very difficult to figure out what are the hot stocks, right? And in hindsight, it's easy, right? You're like, oh, of course Apple is skyrocketing, or of course Amazon is skyrocketing, or of course Google has done well. Of course, it's so easy to say that in hindsight. But when you actually do it, it's not so easy. And then the other thing with buying individual stocks is that it requires a lot of discipline on your part to trade them so that you don't lose money. So for example, before the tech bubble in 2000, I had bought a whole bunch of stocks, and one of them was Oracle, right? And leading up to it, Oracle was I had like 990% return, almost 1,000% return. And I said to myself, oh, I'm going to sell it when it hits 1,000% return, right? And why did I pick 1,000? Because, that just sounded like a cool number, right? And I'm not greedy. 1,000% return, that's when I'm going to sell it. Well, it never hit 1,000, right? It just, got close and then went down and then down, and the stock market crashed, and, it just went all, and, did I sell it for 900% return? Nope. Did I get it for 800%? Nope. 700%? Nope. All the way down. I think maybe I got 100% return, maybe. I don't even remember, right? So after a while, right, buying individual stocks, when it goes up, you're greedy, and so you won't sell it because why would I sell it now when it's going to keep going up? And then when it's on its way down, right, and especially if you're negative, you're not going to sell it for a loss. So it is very hard to trade individual stocks if you don't have that discipline. And a lot of people, they'll just watch the stocks drop, right? And they don't have the right discipline and triggers to sell the stock so that you don't get it for a loss. So don't be tempted to buy, hot stocks or individual stocks. All right, next one, continue saving and investing in your 401k. So, right, these are all your savings accounts. Doing a backdoor Roth IRA, mega backdoor Roth IRA, stock participation plan, health savings account, et cetera, right? So all of these things are your vehicles for, kind of supercharging your savings. In this phase here, you might have kids, you might want to help pay for their college education. If that's the case, you could consider investing and putting money into a 529. You can also super fund it. So super funding it is basically dumping a whole bunch of money into a 529, right early on. And the reason for that is you get to have more doubles, right? So you basically take advantage of the rule of 72 and the compounding that goes on. In this phase, you should consider life insurance, right? Maybe you're the only one working, so consider life insurance, umbrella policy, short-term disability, especially if you have a family or you'll be starting one. These things are all good things to consider, definitely in this phase. You could even look at them in phase one. In this phase two, you should start tracking your expenses and your net worth, right? It's very easy in this phase because, you're busy, right? You may be raising a family, you're paying for ballet lessons, soccer, lessons, swimming lessons, right? You have a gym membership you never use. You have, Hulu and Apple Plus and Netflix and Prime, and you really don't even have time to watch anything. So do you really need all of that stuff? So look at minimizing your recurring costs and also eliminate any expenses that you have. These sites use Mint for kind of just simple budgeting, as well as just tracking all the different credit cards. expenses and having it all come into one place. Personal Capital is a good site. This allows you to kind of add a lot of different accounts. So like, if you and your spouse have 401ks in different brokerage houses, and you have, a checking account here and a mortgage there, and Personal Capital can bring it all together so that you have one place where you could see kind of everything. So that's pretty good. And then if you do want to sign up, this is a referral link. So I think you get 20 Amazon gift card and I get 20 or something like that. But no, they will try to like set up a free, 1 hour meeting with you, which I'm still avoiding. Okay, continue exercising. So in this phase, especially, this is where, the famous, dad bod comes into play, where, you just don't have time. Continue exercising, and especially now, there's so many options on YouTube. There's really no excuse for not getting out and exercising, and also dumping the gym membership. All right. Phase 3. So I won't cover this. This really is about, when you're going into pre-retirement, and, what things you need to consider then, like how much money you need to have to retire, et cetera. I forgot to ask. So any questions on phase 2, the accumulation phase? Okay, let's move on. And then phase 4 is the retirement phase. So again, this is some of the things that you should do in this retirement phase. And you can see exercising is in all phases. That will keep you healthy. And if you haven't seen it yet, but healthcare costs are crazy in the US. And exercise will help you be healthy so that you don't have to go see the doctor, so that you don't need diabetes medicine or heart medicine or this or that. So not only is exercising, healthy, it makes you happy, it'll save you a lot of money. All right, so in summary, right, start saving early and let your investments do the work, right? So it is never too early to think about retiring, okay? That is a typical misconception on, when you're young, right? Like, oh, I'm only 20. Why do I need to think about when I'm 60, right? And the reason is, right, the Mary and John example, if you just think about retiring at an early age and you just set yourself up on autopilot and just take a little money and keep saving it away, right? You won't have to worry when you get to 50 or 60, right? Or, it'll give you the luxury to do what you want at the age that you want, and to spend time with your family or whatever. So start saving early. I cannot emphasize that enough. And then you want your investments to do the work, right? You don't want to save and then just be cash, because cash will lose value. And then the other thing is, you don't want, there's no need to try to hit a home run, right? Because more often than not, you will strike out, right? You don't need to hit a home run. All you need are base hits, right? Base hit after base hit after base hit after base hit. And then before you know it, you'll be 40 and you'll have a few $1 million. So start saving early, let your investments do the work. Slow and steady. There's really no need to try to do GameStop or Bitcoin or other, just speculative type investments. Okay. This is a cool video. I won't play it, but it basically just shows the importance of investing. So this kid, and you might have seen it, he's trying to save up for like a toy rocket, and he saves and saves and saves. And then by the time he has enough money to buy it, the price went up and he can't afford it. All right, so, okay, so I want to invest, but what retirement accounts should I use? Okay, so we're gonna go into that. So really this kind of highlights the differences in, the retirement accounts that a lot of, Fortune 500 companies have, right? So 401ks, health savings accounts, and then we have the other ones that are available to really anyone, right? IRAs, et cetera. This doesn't cover small businesses. So if you, graduate from UCLA and start your own company or whatever, right, you will have different types of accounts that you can choose from, but it won't be necessarily a corporate type of 401k. And then really all of these accounts, the differences are, besides the kind of how much you can contribute to them, it's really the taxation, right? So the money that I contribute, is it taxed, right? Does the money grow tax-free or is it taxed? And then when I withdraw the money and from the account, is it taxed, right? So those three things, and then including RMDs. RMDs are required minimum distributions, right? So these are, this is where the government says when you hit a certain age, you need to take a certain percentage out of that account because they want their tax money. Okay, so certain accounts have RMDs associated with them. So that's really the major difference between all of these accounts, right? It's how much can you put in? Is it taxed up front? Does it grow tax-free? And then is it taxed again when you withdraw? Okay, so the first types of accounts are your 401ks. And you have two options for the 401k. You have a pre-tax and you have a Roth, okay? The difference here is that pre-tax or traditional 401ks are not taxed up front. So the $20,500, you don't pay any income tax on that. Okay, that money grows tax-free, but then when you withdraw it, you get taxed, and you get taxed at whatever tax bracket you're in at the time. Versus the Roth version of 401k. So Roth means I'm going to pay my taxes now. Okay, it's going to grow tax-free, but when I spend it and pull it out of the account, I'm not taxed again. Okay, so see the difference here, right? It's where this tax happens. It's either coming at the end or at the front. The limit here is $20,500 for these 401ks. And then you'll notice here, I have a priority, 1 or 7. So this is kind of a personal decision. Some people feel that tax rates will just keep going up. And so by the time that they retire, the tax rate will be high. Others feel that, when I retire, I'm not going to be making any income. And so my tax bracket will be much lower, right? So it's kind of how you view, your tax rates in the future. So the first one, pre-tax. So if you think you'll be in a lower tax rate during retirement, then the traditional 401k is going to be kind of your priority. And then if you think that you're going to be in a higher tax bracket, then the Roth 401k is kind of a better option. Now, there are slight differences that make the Roth 401k a little bit better. So if you notice, you get to put in $20,500 of after-tax money. So the amount of money to generate that is actually like, $25,000. So you're able to stuff more money in and let it grow, and that money kind of grows faster. So that's one of the advantages of the Roth 401k. And my kind of rule is, if I'm in a lower tax bracket, if I'm in a low tax bracket, and that's something lower than 32%, then I'm going to prioritize the Roth because I want to take those taxes out now, let it grow tax-free, and I'm able to stuff more money in. So that would be, kind of my guideline or rule for when you pick the Roth versus when you switch to traditional. The next one is the health savings account. So again, this one is, if you're single, you can put in 3,650. If you have a family, 7,300, right? This is not taxed up front. It grows tax-free. And as long as you use it for medical, it's never taxed. So this account never sees any tax, right? Which makes it, a great account for savings. The next account I would use in order is the Roth IRA. So the Roth IRA is another, $6,000 that you can put into an individual retirement account where they take the tax out up front, and then it grows tax-free, and then you're never taxed again. Now the one kind of rule with the Roth is if you make too much money, you can't contribute directly to the Roth. So if you're single and you make over 129,000, you can't. The amount that you can contribute starts to phase out, and so at around 140, you can't even contribute $1 to the Roth. Now there is a backdoor method in getting that in there, which is called the backdoor Roth IRA, and that's where you fund a regular IRA, right? So you take tax out up front, and then this account, you would then convert it over to a Roth IRA. And there's no limit on the conversion. There's no income limit on the conversion. So you're essentially getting around this income limit rule. This is another great way to get money into the Roth IRA. The fifth one here, this is the after-tax 401k. This is also known as like the mega backdoor Roth. The rule here is a little bit, it's a little bit of a formula, right? So you start with 61,000, you subtract out your 401k contribution, which is your 20,500, and then you subtract out what your employer contributed, right? So 5%. So on average, approximately, this is like 30,000 additional dollars that you could put into essentially a Roth type account where you take the taxes up front, it grows tax-free. When you withdraw it, it's tax-free, right? It's tax-free basically forever. The sixth account is a deductible IRA. This basically, if you make below 68,000, you're able to like not pay any taxes, let it grow tax-free, but then it's taxed. I would not use this account at all. If you're below 68,000, you might as well just do this Roth IRA and pay a little bit tax. This one also prevents you from doing this backdoor Roth IRA maneuver without paying taxes. So I would just skip this one. The 529, right? These are the accounts that are used for education. It's basically taxed up front, but not taxed again. And then the last one is your taxable savings account. So these are your, your checking accounts, your brokerage, your Robinhoods, whatever. These are taxed up front, right? So every time you get interest from your bank, you're taxed. So when you file taxes, you're going to be paying tax on it. Every year it grows, you get taxed on it. So there's really no tax advantage to this account, right? So contributions are taxed and growth is taxed. But when you spend it, right, you don't have to pay tax because you've already been paying tax all along. So taxes and RMDs are the primary differentiators between all of these accounts. The HSA is never taxed for medical expenses. So the HSA is this third line here, right? So never taxed. So let's see how all of these accounts kind of do, right? So the assumption here is I just take 7,000 at the start and I'm not contributing any more money to any of these accounts, right? And I'm going to assume that the tax rate is a constant 24%. Long-term capital gains tax rate is 15%. And then the annual rate of return is 7%. And then here we're starting at age 30. RMDs start at age 72. So it's hard to see, but basically you have this top line, which is your pre-tax accounts, right? So the contributions, the 7,000 is not taxed. So it starts at 7,000, right? So this is your health savings account. And then this is your traditional 401k, okay? And then there's another line just below it, which is your taxed line, right? So your Roth IRAs, your non-deductible IRAs, right? So any of those accounts on this page here that say taxed, right? That's what is on this kind of second line. And then the last two lines are your taxable savings accounts here. So brokerage or checking versus savings account. And these two split because, for example, the lower line here is interest. So interest that you get from a bank is taxed at your ordinary income versus, say, you get 7% dividends from a stock. Right, dividends are taxed at a different, you're taxed at a long-term capital gains tax rate. So those grow kind of at different rates. Now you can see, right, and this kind of goes back to the question of, should I put my money in a Roth IRA or the S&P 500, right? So, if the S&P 500 is in a normal brokerage account, right, and you get to pick, okay, do I put the 7,000 in a normal brokerage account? Or do I put it in a Roth IRA, right, that doesn't get taxed while it's growing? And you can see, right, that over time, this line will grow faster and faster than, say, this bottom blue line, which is, say, you're getting 7% dividends from that, same investment. So, kind of the takeaway here is tax-free growth has large benefits, right? And you can see it, right, from these lines up here, which are all your tax-advantaged accounts, your 401ks, your retirement accounts, et cetera, versus, your checking account or your brokerage account. The other thing that happens here is at age 72, right, RMDs start to limit the growth that your money has, right? So if you look at this yellow line, right, this is your HSA, there's no RMDs. So it's able to get more and more doubles in, right? So those last doubles it's getting, it's generating a lot. Versus accounts that have RMDs, right, you're forced to start to take money out of it, right? And because of that, these accounts naturally cannot grow, right, as fast as the accounts that don't have RMDs. And so the HSA followed by the Roth IRA are your two best accounts from a tax and RMD perspective. So if you look at it, this is your HSA up here, and then your Roth account is this gray one up here, right? So, it just continues to grow. And then when you take it out, you don't have to pay any tax. Now, the blue line here is your traditional 401k. Now, if your tax rate is the same, right, 24%, whether you take the tax out at the start or at the end, you will have the same account balance. So this blue line, if you were to take 24% out right at this line at this point here before the RMDs kick in, the account value will fall exactly to the Roth line, right? So the benefit here would be, okay, if in retirement I'm no longer at a 24% tax rate, I'm at, say, a 10% or a 12%, then when I take my taxes out, I'm only falling halfway, right? So the account value is higher. So that's kind of the gamble or the bet that you're making, is that in retirement, I'm not going to be in that high tax bracket. Now, that's possibly not always true, right? You could have, maybe you have a bunch of rental properties and you're getting a lot of passive income. Or maybe you have so much pre-tax money that you can't pull it out and stay in a low tax bracket, right? If you pull out, say you have like a few million in a pre-tax, right? You won't be able to withdraw that money kind of fast enough and to stay in a low tax bracket. So that's why, a lot of this, my guidelines are, put money on this Roth line, and then only when you're in a really high tax bracket, switch to this line. And it does a few things, right? It allows you to maximize the money that you're able to get onto this Roth line, because again, you're able to put 20,500, right? So the pre-tax money is really like 25,000 you're getting onto that, you're contributing, versus just 20,500 on this line, and then having to take the tax out later, even if it's only at 10% or 12%. It's the advantage isn't as quite as high as what it what it seems. Let's see. So really the strategy would be, so actually, let me just move to the next. Anyone have any questions on this? Okay, there's one question. So contributing into an HSA and investing is only worth it up to the sum of receipts for all deductibles and foreseeable future deductibles, right? Like maybe go beyond. Yes, that is true. Although premiums for insurance is quite high if you have to pay for it yourself. So for example, like Intel, right? They offer an Intel retiree medical plan that, if you retire from Intel, you can purchase health insurance from Intel. And a lot of people have the misconception that, oh, well, I'm a retiree, I'm going to get free medical health insurance, right? And then say this is before you hit Medicare at 65. Well, for a family of 4, that retiree medical plan, the annual premium alone is like $46,000 a year just for the premium. You haven't even seen a doctor and paid and paid for a doctor visit. You're just paying the premium to have the health insurance. So $46,000 a year for a family of 4. So my expectation is that healthcare costs are going to be very expensive in the future. Now, if if a universal healthcare gets enacted in say 40 years and you don't have to pay for healthcare, right? You can always take that health savings, right? And you can get access to the money. And if you're over 65, right, you wouldn't have to pay penalty. All you would be doing is paying income taxes. So, it's still an advantage to have that go in tax-free and grow tax-free. But then, later you would just be paying tax, right? It would be almost like a traditional 401k, right? Here, tax-free, and then tax. So there's really no huge downside, in my opinion, of the HSA. Oops. So here is just some strategies for the tax savings. I know we're going a little over, but basically, when you start making a lot of money and you've maxed and you have the decision to put money into a regular brokerage account, or if you can somehow get it onto these, tax advantage lines, right? You want to take advantage of those tax advantage lines, right? Like, for example, you might, a bank down the road might say, hey, we're having this grand opening special. I'm going to give you 7% interest for life, right? A checking account, right? And you're thinking, wow, that is fantastic. I mean, no bank is giving anywhere close to 7%. But if you see, right, this green line is essentially mimicking that 7% interest, but it's taxed every year. And so it never grows as fast as, these other lines, and especially these retirement lines. So so when you're able to make a lot of money and still, have savings and investments, right? You can take advantage of some of these other, options here, like this mega backdoor Roth IRA or mega Roth IRA, right? This is another 30,000 or so that you can stuff into the Roth line, right? So you're essentially going from this green line and moving it up to this gray line, right? Another 30,000 every year you can do that. So there's kind of huge advantages of taking using these types of accounts. Now the downside though to some of these is these are retirement accounts, so they don't want you to take the money out when you're 40, right, or 50, right, and they might impose some penalties. So it's kind of a dual-edged sword, right? So in one sense, right, it forces you to keep the money there and let it keep doubling, right? Which is what you want. But if you need that cash for some reason, right, it's not easy to get to. There are ways to get to it before 59 and a half, which is when you can access that money. But it's a little bit trickier, a little bit harder. But it's not impossible for sure. Okay, so this page here kind of just summarizes everything that we talked about. You have your pre-tax bucket, you have your post-tax bucket, and then you have all your other kind of savings vehicles that you can use. So let me know if you guys have any questions on any of this stuff. And I know it's kind of fast, and you might not be exposed to any of this yet, but once you graduate and once you start working for a company, they will start to mention 401k, stock participation, and all these other things.
Yeah, I have a question. So, like, you worked at Intel for 25 years, but a lot of people like pop companies maybe every 2 to 4 years. So, does any of your advice change for like people who do that?
Not really. A lot of companies, they used to have like a vesting period, right? So say like this 401k match. A lot of companies would, maybe contribute money, whether you put any money in or not, and you had to stay a certain number of years in order for that money to vest and for you to be able to get it. So for example, Intel, you had to stay 7 years before the money that they put into your retirement account would be available for you to use, right? So if you left before 7 years, maybe you'd only get a portion of that money. But today, Intel has moved to a matching where, if you put in 5%, they match it right away, and then that's your money. There's no vesting period going on. So it could be that there are some companies that still have this kind of vesting period going on, right? Whether it's, you have to stay for 1 year or 2 years, so that would be one thing to look out for. But in general, kind of the way to make more money is to kind of hop from company to company, because the percent increase for your salaries is quite large when you jump from company to company versus like just your promotions at the same company. So that would be my take. So I don't really see a huge downside to jumping. Is there another question?
Yes. Can you hear me?
Yeah.
So the HSA is only available to those with a high deductible plan, right?
Yeah, that's correct.
Okay. I'm kind of very, very new to this sort of stuff. So if that's the case, then in addition to putting money in your HSA, your risk is also like you're weighing the risk of like you not getting into some like horrible accident where you have to pay $100,000 in debt. Or
No. So the high deductible plan will have a max out of pocket. So usually the deductible. So usually what happens is for the high deductible plans, the deductible, say for a single might be, I don't know, and each plan is different. So this would just be one example. Say it's like $4,000, right? So $4,000 would be your, dollar for dollar kind of payment until you hit that deductible. And then once you hit that deductible, it might switch to 10% payment. So if the fee is $100, you would pay $10 of that. And that switch might carry over for the next like $2,000, right? And then the max out of pocket could be like, $6,000. So if you've paid in total $6,000 in that calendar year, then everything else is covered. So you wouldn't pay a cent more than that.
I see. Okay. I
Yeah.
was
So
just
you won't be out like hundreds of thousands of dollars. No.
Okay. Thank you.
Yep.